Welcome to Debt Free in 30, the show where every week we talk to industry experts about debt, money, and personal finance. I'm Doug Hoyes. So, you've got a bunch of debts. You owe money on 3 different credit cards and a payday loan, and you still owe some money on an old cell phone bill. You've got a job and you've got money coming in every month, but it's hard to juggle 5 different debt payments every month, all on different days, in addition to all of your regular bills. Wouldn't it be great to consolidate all of your debts into one monthly payment? No more juggling your paycheck to make a bunch of payments every month. You would just have one easy monthly payment. Sounds great, right? Debt consolidation does sound great, and in some cases it is a good idea. Other times, not so much. Today on Debt Free in 30, we're going to talk about debt consolidation, the pros and the cons, the good, the bad, and the ugly. A few weeks ago, my guest on the show was Lee Taylor, and I asked him if debt consolidation is a good idea. Here's what he had to say.
People somehow mistakenly think that one payment of $1,000 a month is more manageable than 10 payments of $100 a month. Slightly more convenient, but that's about it. You really have to look at things like interest rates. When people look for consolidation loans, it's usually because they're having trouble financially and they're trying to do something to alleviate the situation. If they've got a bunch of credit card debts they can't pay off, and they go to a financial institution, a high-risk lender, let's say, and that lender says, well, I'll give you a loan and consolidate it, it isn't necessarily going to be at a lower rate of interest. It may be over a longer period of time, sure, but the interest rate, generally speaking, is going to be higher because you're a higher risk. There are, the other side of the sword, as I was saying, is that if you have short-term debt, let's say a bunch of credit cards, and you're paying somewhere between 18 to 22% interest on it, it might be wise to roll that debt into, let's say, a second mortgage. If you've got some equity in your house, you can probably roll it into a second mortgage for somewhere around 6 to 8%. You can spread the payment of that mortgage over a number of years. Sometimes second mortgages can go for 15 years. And what that does is it reduces the amount of interest that you're paying on it. It can then be that you pay it off quicker because what you save on interest you simply put back in to cover the principal again. By spreading it over a number of years, you you can create a solution to the cash flow problem. You just don't have enough money to pay the short-term debt every month, and it can spread that out over a period of time. And that can solve a financial problem. Now, the problem oftentimes related to that is people don't change. The lifestyle habits that they created, spending habits, etc., that got them into the difficulty and created a whole bunch of credit cards, oftentimes doesn't change. So they end up with a consolidation loan. Now they find they have some extra money left over every month because of the cash flow improvement, and they don't change their spending habits. All too often, we see people that went through the consolidation route only to end up 4 or 5 years later with a bunch of credit cards again, maybe the same ones, and now they've got a bunch of credit card debt at 18 to 22% plus a consolidation loan that's been going on for 4 or 5 years, and they find themselves pretty well strapped without too much of a solution other than bankruptcy at that point in time.
So the consolidation loan treated the symptom, it didn't treat the problem.
Right. So unless you really get into the good budgeting and financial management to keep you out of debt and put you back on track, the consolidation loan has done very little except just put the problem off for a couple of years.
So the key point here is that before you consider signing up for a debt consolidation loan, you have to ask yourself an important question. Why am I in debt? The answer, of course, is that you're in debt because you spent more than you brought in. That's the real issue. So will getting a debt consolidation loan solve your budget problem? No, it won't. So you've got to address the cash flow issue first. If you're in debt because you were out of work, but now you're working and have a good job, you may have already solved your cash flow problem. So a debt consolidation loan may be a good way for you to lower the interest rate you're paying and get back on track. But if you're in debt because you have a fancy house, an expensive car, and you go out for dinner at expensive restaurants 5 times a week, a debt consolidation loan will not solve your problem. It might buy you time, but it won't help you reduce your debt. You have to deal with the underlying cash flow issue first. So let's assume that you've dealt with the cash flow problems and your budget's in good shape, but you have some high interest credit card debt that you'd like to deal with. you want to replace your high-interest credit card debt with a lower interest rate debt consolidation loan. We all know that the lowest possible interest rates are on home mortgages. Banks are willing to give you a good deal on a mortgage because it's secured by a house. If you don't pay, they take the house, so they're almost always guaranteed to get paid. It's low-risk lending, so you get a better rate. So is getting a mortgage a good strategy as a debt consolidation loan? How does it work? What kind of deal can you get? To find out, I'm joined by a mortgage expert, so let's get started. Who are you and what do you do?
Thanks, Doug. My name is Mark Morrow. I am a licensed mortgage agent for Ontario. I've spent the last 30 years in financial services, working for many of the major banks, working for some of what we call B lenders in the past. I've written policy for the major banks, as well as run the sales forces nationally and all those sorts of things. Right now, as I said, I'm a licensed mortgage agent, so I deal with a number of lenders in Ontario, including banks, all the way through to the private lenders. So my approach is enter a situation, try to figure out what the customer's needs are and what the best solution for them is. And because I'm a mortgage agent, I've got lots of flexibility and lots of options available.
So we're talking about debt consolidation and refinancing. So what does it take? Explain to me, what does it take to refinance my house, to borrow some more money so I can pay off some existing debt?
Well, the starting point is really around where you are in terms of debt, where your credit history is, and all those sorts of things. So we'll start with the simplest one. We'll start with the A borrower, and the A borrower is classified basically as a bank borrower. Right, so you've got clean credit, you've got an income, you've got all those wonderful things. Those kinds of restructurings are fairly straightforward and easy in general. The things that you require are pretty much all the same all the way through. On the other side, if you get a customer who's got some damaged credit or perhaps some fudged credit, then you've got a different situation altogether. Still possible and a lot of opportunities, a lot of flexibility there, but there's a slightly higher need for more documentation and certainly more checks and that sort of thing. The biggest difference between those two, though, is that, as to your point earlier, the banks like to lend to the borrower. So that's why they lean towards the low-risk customer who's got great credit history, who's got the income and everything else. The B lenders focus more on real estate. So they focus first on the security. So that's a good news and a bad news story, because those lenders will do some things that are outside the box for an A lender, which in the case of somebody who's really credit challenged, gives them more opportunities and a lot more flexibility than I think people really know about.
So that's a key point then. An A lender, or I guess an A client, can go to a bank.
Yep.
And the bank says, how much income do you have? Well, we're looking at you specifically. Whereas if perhaps I've had some challenges in the past, I've gone through a bankruptcy or a proposal, I've got a whole lot of debt, then the bank, not so eager to look at you. You're then going to a different lender who is going to place more emphasis on the value of the real estate they're going to be financing. Is that what you're saying?
Yeah, in essence, that's it. So it goes back to what I said my approach was initially. So what we generally do is we'll take a look at the client situation. And wherever we can get the client the best deal, and by best deal, I don't just mean rate. I mean in terms of what can be actually done to help them in their situation. That's where we'll go to it. So we've got, as I said, we've got lots of flexibility. The banks will stop generally at 80%. CMHC, as an example, will not do credit restructuring kind of deals, but we've got these other B lenders that that's their playground. That's where they like to go.
Well, I'd like to hear how all of that stuff works. So what we're going to do is take a quick break, and then we're going to come right back here with Mark Morrow on Debt Free in 30 and figure out exactly what does it take to get a refinancing done. We'll be right back.
You're listening to Debt Free in 30 with Doug Hoyes. We'll be right back.
Looking for information on budgeting, debt consolidation, credit counseling, debt management, and debt settlement? For unbiased advice, go to moneyproblems.ca, the website for Canadians with money problems who want money solutions. moneyproblems.ca.
We're back here on Debt Free in 30. I'm Doug Hoyes. My guest today is Mark Morrow, and we're talking about debt consolidation, and more specifically, debt consolidation when you're using your house as collateral. So, Mark, I want to throw at you a scenario here. So let's assume I'm sitting in your office right now, and I tell you that I bought my house a few years ago and it's gone up in value, and I just had a local real estate agent tell me it's worth $400,000. My mortgage is $250,000. I've got $50,000 in credit card debt I'd like to pay off. So what's it going to take for me to borrow $50,000 against my house so that I can use the money to pay off my debt?
Well, Doug, the starting point for all of this is the house itself, obviously. So even though a real estate agent may have given you a value, one of the first things that has to be done is we have to get the house appraised. And just to establish that $400,000 is the appropriate amount or the value of the house at that time. Because all of this lending is really driven off of ratios, the amount of debt to the value of the property. So the next thing we have
So just on the appraisal then, so how does that work? Who do you use to do that? Do I have to arrange it? What's that going to cost me? How does that work?
Well, appraisers, there's a number of appraisers in every community as well as some national organizations as well. It's really determined by the lender that you're going to use. Some of them are very adamant as to which appraisers get used, that sort of thing. But in general, it's very, very quick and easy. The work is on my side of the fence. I'm the one who orders the appraisal. Once I've determined where we're going to go with the loan, because certain appraisers fit certain lenders and certain ones don't, as an example. In general, you're looking at a price tag of about $250 to, I've seen them as high as $350 for residential mortgage, but when you get up into the higher end, that's usually because they're rural properties or
something more complicated.
Investment properties as an example. So if you've got a multi-unit, if you've got a fourplex, that sort of thing, you've got rental income, then there's a little more work required by the appraiser.
And is that something then I would just pay directly for? Is that how that would work then?
Yeah, in terms of brokering and in terms of getting refinanced, whether you're talking to a bank or whether you're talking to a broker such as myself, is that's the one piece of work that has to be done up front. Before we can actually move forward with anything, whether you've got great credit, and you're moving forward, or whether you've got fractured credit, we still have to start with the house. Now that's the only upfront cost that's involved in general with any of these kinds of transactions.
Okay, so the first step is the appraisal, where you're going to bring someone in, figure out what the house is worth. What happens next then?
Well, just working off of the scenario that you gave me, in this case, if you take the 250 plus the 50,000 in credit card consolidation, let's assume that the house is worth 400,000. That 300,000 is 75% of the 400,000. So the next step is determining what's the profile of the client. Do they have good credit? Do they have bad credit? If they've got good credit, this is pretty straightforward and easy. We can go to a regular bank, or we can go to really a mortgage bank. So they operate and have the same rates and similar products as the regular banks do, quite frankly. Those are pretty straightforward. The advantage to working with somebody with me, though, is that quite often I can actually get you a better deal and a better rate than you can get through the branches. If you're on the other side of the coin, you've got a B client, and by A and B, we've already determined that's what it means. So we're in damaged credit area, or not necessarily damaged credit, but we're in a tougher spot. Then at that point, we've got the same process basically. So we've got to get the appraisal done, and then we got to find the appropriate lender.
And so the appraisal's done. So in the scenario I gave you, it's pretty simple.
Yep.
Because you said it's going to end up being 75% loan to value.
Yep.
Meaning the mortgage at the end of the day is 75% of what the property's worth. So let's make it more complicated then. Let's say it's a higher number than 75%.
Yeah, again, it's the first question is what's the condition of the customer's credit. So A credit, you're pretty good to go up to 80% or even above that.
So 80%, and what's the magic about 80%?
The magic of 80% really stems from the Bank Act. So banks are, under the Bank Act, are required to not lend above 80% without having a mortgage insurer in place.
So let's talk about mortgage insurance then. Yep. So what are you talking about there?
Well, mortgage insurance is really insurance protection for the lender. So it protects them against default on the mortgage. So many, many years ago, the banks within the Bank Act determined that banks can lend on their own volition up to 80% of the value of a property. Once they go beyond that, they can still lend, but they have to get an insurance policy in place. And those insurance policies are provided predominantly by CMHC, a company called Genworth, or Canada Guarantee.
So there's three companies, the biggest one being CMHC.
Yep.
And if I'm not mistaken, CMHC is actually me, right? Because that's a Government of Canada thing, and so it's really my money that's supporting that, I guess.
Yeah, all of our money, yes.
All of our money. Yeah, I guess I'm not the only taxpayer in Canada. You're property.
If you will take that on,
No, I can't afford this country, let me tell you. So if I'm refinancing my house,
yep.
If I go over 80% loan to value, the lender has to have insurance either from CMHC or Genworth or whomever. And
just let me clarify that a little bit. If they are a bank and institutional lender that has to abide by those rules, so either the Bank Act or some of the other trust company acts and that sort of thing, credit unions is an example, then they're forced by law to impose that insurance. Private lenders, mix, some of the secondary lenders don't have to have that insurance in place, but they'll do their own kind of self-insurance. So when you take a look at the two, it's really comparing different kinds of apples, but they pretty much operate the same way.
So if I was a really rich guy and I had millions of dollars and I wanted to start a mortgage company, I could do that.
Yep.
I could loan to whoever I wanted. I wouldn't have to have mortgage insurance. But realistically, like you say, well, I'm going to price it accordingly then. And so as a consumer, you probably end up, paying something similar to it one way or the other, I guess is what it comes down to.
Yeah, basically, if we can just sort of take a little bit of a tangent here, when you have to get mortgage insurance in place, it's done on a premium basis, which is a percentage of the total amount of the mortgage that's going to go out. That premium gets added to the value of the mortgage. So in this case, we said $300,000. When you add the fees, you're going to have with a mortgage that's going to be more than $300,000 because the insurance premium is going to be in there. So when you're talking about CMHC and let's just stick with the purchase for a second because it's a little bit cleaner. The rate of fees is between 0.6 and goes up to roughly 4% right now, or 3.5%, somewhere in that range. When you're in the B market, the fees or the premiums rather are pretty similar. Now they don't necessarily call them premiums; they're going to call them fees, lender fees, that sort of thing. But you're within a point or two of that, so they're pretty comparable, quite frankly.
Gotcha. So 80% is the maximum if I'm refinancing my house. What if I'm buying a house brand new?
Well, let me just correct something there. 80% isn't the stopping point. 80% is the stopping point where you need insurance.
Okay.
So if you've got really clean credit and you want to refinance beyond that, we can get it done at a bank and we can get it done with CMHC insurance on it. If you're doing a debt consolidation, though, so you've got some fractured credit and it is really, we're trying to clean up a mess, then CMHC will stop. They don't do default management situations on their insurance, but all the B lenders do.
Gotcha. So what's the maximum I could go to then in that scenario? So let's say, fractured credit, but I have a house with equity in it. I can go over 80%, you're saying.
Yep.
And can I do that with a bank through CMHC, or am I pretty much with a B lender at that point?
Again, it comes down to what is the if it's a self-imposed debt consolidation, as an example. If you've just decided that you've got too many credit cards, you want to address the situation, but your credit's in great shape, then that kind of debt consolidation is really just an equity takeout, and we can get that done at almost any bank. If, however, you're under pressure, so you've got some delinquency on your accounts and those sorts of things, and you're getting calls from creditors and that, people of that ilk, then you're in a different category. So there are limitations on whether or not we can go over that 80% with CMHC or Genworth or Canada Guarantee in place.
So it is possible. It's certainly not guaranteed. So really what you're saying is it's a lot easier to borrow before things get really serious.
Yeah, I mean, that's the end of the equation, is that. I mean, you sort of led into it before, is that the time to get this under control is before it becomes a problem, quite frankly.
And under those scenarios, it is possible to get decent rates, decent values, but once you've got lots of judgments and things on your credit report, it's going to be a whole lot more difficult.
Yeah, it's going to be more difficult. Let's put it that way. So going back to your original question, if we're in that category, then we slip into what I call the B market. In that case, we can go, I've seen some deals 100%, but not very many. But you can comfortably get to 85, 82, 85, and even up to 90. I've just recently done one that was 90% with capitalized fees, takes it slightly over that.
Which I guess is that's why you deal with a mortgage agent. You're able to shop the market, find the best deal, and help people get the deal that they need. So I appreciate that. We're going to take a break and come back to wrap it up here. My guest today was Mark Morrow. You're listening to Debt Free in 30.
What are the warning signs of debt problems? Where can I find a free online debt options calculator? Where can I get free ebooks and guides? Find all the answers at moneyproblems.ca, the website for Canadians with money problems who want money solutions. Moneyproblems.ca.
If debt problems are keeping you up at night, if collection calls leave you afraid to answer the phone, it's time to end the cycle. You can do something about your debt. Call Hoyes Michaelis today at 310-PLAN.
You're listening to Debt Free in 30. Here's your host, Doug Hoyes.
Welcome back. It's time for the 30-second recap of what we discussed today. On today's show, we talked about debt consolidation loans. Lee Taylor explained that one monthly payment in a debt consolidation loan is more convenient than making multiple payments on multiple debts, but it only makes sense if you can negotiate a lower interest rate. My second guest, Mark Morrow, explained how it's possible to get a debt consolidation loan by borrowing against the equity in your house, but there are limits on how much you can borrow, and if you have less than perfect credit, your monthly payment will be higher than it would be for someone with perfect credit. That's the 30-second recap of what we discussed today. So, what's my take on using the equity in your house to consolidate your debts? You can finance more than 80% of the value when you're buying a new home, but on a refinancing, it's much more difficult to borrow over 80% with a conventional bank. So unless you have sufficient equity, refinancing your mortgage may not be a debt consolidation option. So if you want to refinance your house, the first question will be, what's the house worth? And that question is answered with an appraisal. And as Mark said, the bank will tell you which appraiser to use, and you're paying the cost. If you do have sufficient equity in your house to refinance, the next question will be whether or not you can afford the monthly payments. If you can't afford it or don't qualify, refinancing your mortgage is not the correct option. And that gets us back to what Lee Taylor said. If you have too much debt, the most important step is to change your spending habits so that you can start paying down debt. And that's the most important point. Debt consolidation does not reduce your debt. All it does is replace one set of debts for another. Your total debt remains the same. It may be a good option, but only if you can reduce the interest rate you're paying and only if you can keep your budget balanced going forward. That's our show for today. Full show notes are available on our website, including information on debt consolidation. So please go to our website at hoyes.com, that's HOYES.com, for more information. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.
Thanks for listening. This was Debt Free in 30.